How do you read an Experian commercial credit report? We're going to talk about that today. I'm going to show you everything you need to know about your Experian commercial credit report, including the credit scores that you may see on there, the information, how they get the data, everything to navigate this report. Now, here's why this is so important. Experian is secretly the one behind the scenes that most credit card issuers use. So we look at Dun & Bradstreet, we look at Equifax, we look at Experian. Equifax is commonly used by banks if you want loans and credit lines. But if you want credit cards, you need to get this right. You need to understand how the Experian scores and report works. You need to be able to monitor this. You need to make sure you control the information on here, because this is the difference between getting approved and denied for a lot of things, including credit cards. And it's also going to determine how much you get and the rates and terms you're going to pay. We got a lot to cover here. So let's dive in and get started. Okay, so first of all, of course, we're talking about business credit reports. We're not talking about consumer credit reports. Let me get that started. So we're talking about credit reports that are built for a business's EIN that are not linked to your Social Security number as a business owner. So of course, Experian is in the consumer credit space as well. You have consumer credit reports with Experian. That's not what we're covering today. Today, it's all about Experian commercial. It's about controlling your Experian commercial credit report so you can get better financing for your business, including get business credit for your business as well. Speaking of business credit, there's three major business credit reporting agencies. Dun & Bradstreet, by far the biggest. They have 230 million records on file. I only tell you that just so you know the size of them. Then we look at Experian. To give you a comparison, Experian has about 23 million records on file. And again, I only tell you that so you can get a difference in the size. 230 million, Dun & Bradstreet, Experian's 23 million. And Equifax is even further behind that. So, but Experian is the second biggest player in the business credit scoring world. As I mentioned, they're very important because they're oftentimes used by credit card issuers. I'm going to give you a little backstory on that just because it's interesting. Dun & Bradstreet used to be probably the most commonly used by lenders and credit issuers. Dun & Bradstreet rolled out a product they call their Credit Builder, which is where you pay them money to add accounts you have now to your Dun & Bradstreet credit report. They got into the business credit building game on their own credit reports. A lot of credit issuers did not like that. They felt that the integrity of Dun & Bradstreet's data was compromised. And as a result of that, they started to shift to Equifax and Experian. So that's the world that we now have today, whereas Equifax is commonly used by banks. Dun & Bradstreet is still commonly used by insurance providers and suppliers and many other different outfits and organizations, even lending institutions. But Experian is most commonly used by credit card issuers, the major credit card issuers in the country. And then we've got FICO SBSS. They're not really a credit bureau, but they do offer a credit score. FICO, we're familiar with on the consumer side. They have a business score called the SBSS score. And then on top of that, we have CreditSafe. And CreditSafe has always been really big in the UK, but they are making the presence over here in the United States. And I tell you that because if you're focused on building business credit, you should be focusing on building business credit with CreditSafe as well. Because if not, it's going to be a problem for you in the years to come. And CJ, aloha, thanks for coming in, man. I appreciate you coming in from LinkedIn. So today we're going to focus on Experian. So when we look at Experian, like other CRAs, they're all about providing data. And I think that we forget about that, what the credit bureau's actual job is. The credit bureau's job is to gather data about us and then sell it to whoever will buy it. It's different in the consumer and commercial world because consumer world, people can only get your credit reports with your permission. In the commercial world, it's publicly accessible. If I go to Experian's website right now, the first question they ask me is, do I want to pull my report or my credit or somebody else's credit report? So their whole job is to gather data and protect the accuracy of that data and then sell the data to whoever wants it. I mean, that's what the credit bureaus at their core consumer and commercial ultimately do. They own a massive consumer and commercial database. Equifax and Experian are both very big in those spaces as well. And then they have proprietary algorithms and software and other things that they use, analytical software, to be able to assess scores to determine risk. Again, very different in the commercial world. In the consumer world, FICO is kind of the main one. We've got two scores in the consumer world. Vantage, which is owned by the credit bureaus. Then we've got FICO. And what happened is FICO dominated the credit score space for a long time. Then the credit bureaus got together and went in on Vantage score because they wanted to kind of not push FICO out, but they wanted to have their own score that took priority over FICO. In the business world, we see these bureaus all have their own scores, about 5 of them. So Experian has about 5 scores. Equifax does. DNB does. So they're controlling their own scores, their own proprietary analytics and scoring system, where they're not really relying on FICO to be able to put credit scores on the reports like we see in the consumer world. Now, they use both consumer and commercial data. They're the only ones of DNB, Equifax, and Experian that does this. DNB is not even in the consumer space, which means you can see these blended credit reports from Experian where they have a credit score that takes into account your consumer data and your actual business data, your commercial data. Now, you might say, well, that's not fair, but we'll show some of the statistics on why they do that. So they found that they tout that this is more effective and a better way to gauge risk. For troubled businesses, blended scores dropped an average of 30% over the 4 quarters leading up to a bad event. So again, what they're saying here is by gathering both data, they're able to predict a year ahead that somebody's potentially going to default. Here's some other interesting stats from them. 53% of the time, the first signs of credit problems were on the business credit reports. Now, this is interesting to me. So, and I lived through this. I had a business that failed the mortgage crisis. And this is what happened. We started to go late on business accounts first. So our business credit reports were the first to see that damage. 46% of the time, the first signs of credit problems were on the owner's credit report. So what Experian is saying is, look, half the time that somebody's in trouble, you see it on the commercial report. Half the time it's on the consumer report. So if you blend these reports together, you get a better range of risk. And that's why they say that blended scores have been found to outperform consumer or business alone by 10 to 20%. This is why they actually promote it. Now, per them, by combining personal and commercial credit information on one report, Experian provides a complete picture of the creditworthiness of small businesses. So this is the bad news, that they have a blended report that brings in consumer and commercial scores. Here's the good news. It's not popular. Very, very rarely will you ever see the score used. And the reason for that is because somebody needs your permission to access your consumer credit data. They don't need your permission to access your commercial credit data. So if anybody's using a blended score to underwrite a business file, they have to ask you for permission to get your credit score. But if they're just using commercial credit scores, they don't need to ask you for permission. They can get those without asking for permission, without you signing anything stating you're authorized them to do so. So we just don't see blended scores used often, although they are touted by Experian to be significantly more predictive of risk than just commercial or consumer information. Now, Experian provides a sample report where you can get an idea of what to expect. The best, most accurate and data source for them is their website itself. And you can go to sbcr.experian.com to actually access the credit report. As a matter of fact, during our training here, I am going to probably pull up an Experian credit report. So I'm going to look over here and get that done as we continue on. Okay, so the first part of the report contains your name, your address, your main phone number, and what's called your BIN number. So obviously the name of the business is on the commercial credit report. The address, the most recent or address that they believe belongs to you, is on your commercial credit report as well. And your phone number is on that commercial credit report as well. Okay, so again, this is the main stuff that we see at the top of a credit report, and your BIN number, which is your identifying number with Experian. Okay, so this is the actual number with Experian. I'm going to look at a credit report here to show you this. So if we look at a commercial credit report, this is what we see. We see up here the actual name of the business. We see the ad right here. We see the address of the business, and we see what's called a BIN number, a business identification number here. Now, first of all, I can share this with you because business credit reports are publicly accessible. I can show you the Trump Organization's credit report if I want to. As a matter of fact, during the initial election, I showed Clinton Foundation's credit report and the Trump credit report too. So it's publicly accessible information. I can show you this, and anybody can access this information. So we see here name, address. We see business identification number. Now with a BIN number with Experian, you don't need to apply to get a BIN number like you do down in Bradstreet. What does happen is they will automatically assign it to you once a credit report is created for you. So once a credit report is created for you by Experian, they will automatically assign a BIN number. You don't need to go get it separately like you do a DUNS number. And we have annual sales. So if annual sales are on a commercial credit report, it's right down here. If we know the industry code, if we know the sales amounts, it's right down here. Let me see if I can pull up a commercial credit report where that is. Here we go. Well, no, this doesn't have one either. You can see here they see the NAICS code, but we don't know the revenue. But if we do know the revenue, right here we go. There we go. Boom. There we go. So here we go. We have the business name. We have the business address. We have the BIN number. We have the phone number, just like we said. And then we see here what the sales are, what the actual gross of the revenue is. We also see the number of employees that they have and the NAICS code, the SIC, the code of the business. This is all initially on the top part of the commercial credit report if they have sales. Now, again, this is one of the interesting things about commercial credit reports is you can actually decide if you give them that information or not. So if you want to give Experian, D&B, and Equifax your financials, then you can do so. And that will actually help some of your credit scores if the financials are good. If you don't want to give it to them, they don't. And we just looked at a bunch of different examples here where what we found was that there are Equifax and there are credit reports here that have sales, that have NAICS codes. And then we find ones where they have just the NAICS codes. And then we have one where they have none of that data. And you can actually see in these three examples the clear difference between what these credit reports look like with or without that information. Now, the section also contains business type, corporation, entity type, a date Experian file was established, years in business, total number of employees, incorporation date and state as well. So we can see all of that information on a commercial credit report. Let's look at this with Experian. Here we go. Years on file, state of corporation, date of corporation, business type, okay, contact information. It's all in this section. And again, if we look at this, we can also see gross sales here. We can also see SIC code, and we also see NAICS code. And we can see what it looks like when we don't have that data. So here we see years on file. Here we see state of corporation, date of corporation, business type, and contacts. We don't see here that. They don't have that information. Here, so you can see the difference between having this stuff and not having the information on the commercial credit report. And this is why this is important, is that the more information they have, the better they feel they can assess risk. So it helps some of your scores just because they have all this information. It's not a bad idea to be able to go to Experian, Equifax, and D&B through their own systems. Equifax Experience through credit monitoring, D&B is through a system they call their dashboard, and update your information with them. Give them the correct SIC, give them the correct NAICS. Tell them, whether you're a corporation, when you filed. If you give this information to them, they have a more complete picture on your business, and it typically helps you unless you're in a high-risk industry. If you're in an industry they don't like, then knowing your industry can actually help give you a lower score. And we'll talk a little bit about that as we proceed as well. So business credit scores range from 1 to 100. Higher scores mean lower risk. You want to get a high score, it means you're lower risk. And the score, the main Experian's main score is called IntelliScore, and it predicts the likelihood of serious credit delinquency within the next 12 months. So there's two things I want to point out here. First of all, Experian, Equifax, and D&B, all of their credit scores are exactly the same. They depict your risk of going late over the next 12 months. Now, by serious delinquency, we mean 90 days late. So your main credit scores with Experian, Equifax, DB, what they do is they predict your likelihood of going 3 months late, 90 days late on an account. That's what they're actually predicting. Okay, over 12 months. This is interesting. Consumer credit gauges your risk of going 90 days late over 24 months. Commercial credit gauges your risk of going 90 days late over 12 months. So the reason I find this interesting is that business credit reports are more forgiving than consumer. Like if you mess up on a consumer credit report, they're looking at your risk of default over the next 2 years. You still got a good risk of default, even if you have a mistake. But with this, you can fix a mistake and bounce back fairly easily and quickly because it's only looking at your risk of going late over the next 12 months. So the minute you kind of correct the error, get more positive accounts than negative, it's easier to boost those scores up. It's easier to bounce scores back in the commercial space and the consumer space. So the scores use trade line and collections information, public filings, as well as other variables to predict risk. So let's look at this. Credit scores are calculated here based on trade experiences, accounts like these that come from what we call trade vendors. So a lot of people in business credit space misrepresent vendors, and people think vendors are the ones you start building business credit with. Really, anybody's a vendor that reports to the business credit reporting agency. Staples, Office Depot, Sam's Club, they're all vendors. There are starter vendors and regular vendors. So any vendor that reports an account to them, we see right here, all of these what are called trade or payment experiences calculated into the score. So basically, how is somebody paying their bill? Are they currently current? Do they have balances? What's their recent high credit limit that they've used? Okay, how are they managing it? Now, the other thing we've got is public records. Now, there are none here. We don't have any public records. We can see here that there are no UCC filings. There are no judgment filings. There are no tax liens. If those were on here, then what would happen is we would start to see those down here, but we don't see those. So it takes into account lawsuits. It takes into account judgments, tax liens. They don't have any of these. We can also take into account collections. This person has no collections either. And then it also takes into account all these positive payment experiences. So all of that stuff is what's calculated into Experian's main score, which is called IntelliScore. And the section of the report has a graph showing that. It absolutely does. As a matter of fact, there's actually some interesting graphs on this credit report. And here it is. You can actually see the trending data quarterly of where the scores are. And then you can also come down and see this other score, financial stability score. We'll talk about that too. Okay, you can also see the trending data here too. So we see the trending data. But here's what I think is interesting, and this is one of the things I want to point out. This is what happens when you go from no credit. This is somebody that has no credit on their credit report. I talk about this all the time. So here's somebody that has no credit. They have a low score. If I scroll down, you can see they have zero credit. I'm at the end of the credit report. See how there is no trade data down here compared to this one, where if I scroll to the bottom, I can clearly see all these payments. There is no payments here. There is none, right? It's all zeros. Okay, but they have a failing score because they have no credit. Now, here's somebody that added one account to their business credit report, and I'm going to try not to scroll too fast because I don't want to make anybody nauseous here. Okay, but here they only have one account. You can see them at the bottom, inquiries, corporate linkage. Then we have trade payments, only one, but we can see that they went from a very low score to very high score. So these trends even show you what it's like to go from no credit to good credit just by adding accounts to your credit report. So you clearly see the trend of this person to go from no accounts and a 28 score to one account and up into a 93, 96 score because they paid that one account as agreed. So it shows you that trending data as well. Okay, now key score factors: number of commercial accounts with terms other than 1 to 30 days late, number of commercial accounts that are not current, number of commercial accounts with high utilization, length of time and experience credit report. Okay, now beside that, let's look and see from Experian what's causing low scores. Okay, so when we look at this, we can actually come in, and when we look at this credit report, we can actually see from Experian what's causing the scores to be low. Now, here's what's interesting. Remember, we looked at somebody that has no credit. This person had no credit whatsoever on their commercial credit report, right? And so what's interesting is that it says that the reason that they don't have a high score, the reason it's low is because the risk associated with the industry and the business type. Now, this is IntelliScore. I'm going to show you this. This is interesting because this one says lack of trade lines. Okay, risk associated with business type, employee size of business, risk associated with company's industry sector. This is so important. I can't even stress how important this is for you to have good scores. Let's look at what Experian just told us here. They don't like this person and they're very high risk because they don't like the risk associated with the industry. Notice how important industry is. They don't like the company's business type. That could be structure. I talk to you about this all the time. Experian is saying they don't like that way the business entity is set up. So corporations are better entities than limited partnerships and partnerships than sole proprietorships. And you can see somebody getting dinged because of their entity type right from Experian themselves. But here's why I want to show you this. Industry is so important that industry is the main factor that's bringing down this score. Industry associated with business type. Here we have industry. We have the type of entity again. Here we have risk associated with industry again. Experian does not like the industry. And because of the industry, they are giving this person very low scores. Now, I'm about to show you what this financial stability score is, but I want to show you the importance of industry and Experian saying it. Lack of trade lines, obviously a big factor. This person has no trade lines. That's why they're given a failing score, and Experian's telling us that. But here's what else is interesting. If Experian doesn't have your financial data, so remember, I've showed you credit reports where we have the financial data and we don't. Here, we have financial data. We know that the company does $200,000 in revenue. This credit report, we don't. We didn't give them tax returns. So what happens, this is so crazy. So what happens is Experian will then look at the number of employees you have to determine the financial health of your company. So let me state that again, because it really doesn't make any sense to me, but it is the way that it works. If the credit bureaus do not have your actual financial data, if you have not supplied tax returns to them like Christine did here, if they don't have this information, if they don't know your revenues, then your financial health is determined based on the number of employees you have. And if they don't have that data, or it's a small amount of employees, what happens is then they score you lower, and they'll even tell you that your employee size is the problem. The employee size is only the problem because they don't have your tax returns, they don't have your financials. So pretty interesting stuff. You see the importance of knowing your industry. And again, I've talked about this all the time because it's important. If you don't know your industry, then the problem is, and you might say, Ty, I'm in, whatever industry. I talked about this yesterday in a training. If you don't know your industry, and let's look at this, and I always use the same example. If you say you're in real estate, what you don't realize is that there's 32 subcategories of real estate. Look at that, 32. So if you tell somebody you're in real estate, go to set up a bank account, apply for a loan, apply for a credit card, apply for a credit line, go do anything where you're telling somebody that they have the industry and you're sending in an application, this information gets into the credit bureaus. If you're not precise about your industry, then they determine the industry for you. They put you in an industry they think you're in. So if you say I'm in real estate, well, then they pick one of these. You didn't tell them which one of these you're in, so they have to pick one. That's why you need to know your industry. You need to know that you are in residential property management and your NAICS is 531311. Because if you don't do that, then what happens is you create a scenario where they're making up an industry for you. They're determining the industry that you're in, and the industry that you're in, they very well might not like. And if they don't like the industry that you're in, then you come in and you get these lower scores and these warnings telling you they don't like the industry. And by the way, this is what's absurd about this example. This person's a dance studio. Like, how do you not like dance studios? Like, how can dance studios be high risk? That doesn't even make any sense. But again, this is how the system works. And it's important for you to know this to be able to maximize and get your good scores. So the financial stability risk rating is from 1 to 5. Lower scores indicate lower risk. Okay, financial stability risk rating of 1 indicates like a 0.5% potential risk of severe financial distress within the next 12 months. So let's talk about this. So these scores, the two main scores you see on Experian, one is IntelliScore. Remember, IntelliScore is mostly made up of how you pay your bills. It's actually, there's 5 different components of IntelliScore. About 85% of the score is how you pay your bills. Do you have collections? Do you have late payments? Do you have public records? Like, what is it that you have? If you have negative information on your credit report, your IntelliScore goes down, and this mostly is based on your payment history. This depicts your risk of going 90 days late in the next 12 months. Then we see the second score, which is financial stability score, which, by the way, this IntelliScore it's just showing it in a different format. Okay. Now we look at current financial stability risk score. Financial stability risk score literally depicts your risk of going bankrupt in the next 12 months, shutting your door, ceasing operations, closing down your business, filing bankruptcy, whatever you want to call it. That's what it depicts. So remember here, we've got somebody that has no credit, none on their credit report. And look at how high risk they are of failure. Experian saying they are a major high risk of failure. And Experian is saying that because they don't have trade lines. So Experian and Equifax will do this to you and crush your credit scores because you have no credit, right? Here we are, end of the report, no credit. So you got to be careful because when you have no credit, they automatically will assess you as almost a higher risk you can get of filing bankruptcy because you have no trades. Now you compound that with not liking the entity you've chosen, not liking the industry, not having financial data where they don't actually like the number of employees you have. You compound all that, and that's why we see these scores so low. So this is why you've got to build business credit, because when you build business credit, it radically offsets it. So I'll show you an example. Here's somebody that went from really high risk to middle of the road risk, and they say, hey, look, we still don't like the number of accounts they have. They only have 1 account reporting. Okay. But again, they're lower risk, that 1 account. And we look at the same factors. They don't like the industry. They don't like the business type. They don't like the size of employees. The same warnings as we saw in the last credit report. But adding 1 positive account boosted somebody from this high risk section all the way here to middle risk. And the more accounts you'd add, the more you get closer to lower risk. So I'm telling you this because after studying 10,000 business credit reports, what we noticed is that the number of accounts you add and are paying as agreed really directly controls these 2 scores. If you just get accounts and add them that are positive, you can get past them not liking your entity type, not liking your NAICS, not knowing your number of employees. But let's be clear, you can control that. You can actually come in, tell them the industry that you're in, fix that problem. You can set up the right business type, meaning set up a corporation, which is what they want to see, and you can supply financials and you can fix all these factors. Very rarely in the consumer world can you really fix the factors that are affecting your credit world. You can absolutely do that in the business world. So we can see that example here, that these are all things within your control to be able to actually fix. Now, Experian categorizes all businesses to fit within one of these 5 risk segments that we talked about with that actual financial stability risk scores. And the key factors are number of active commercial accounts you have, business type, we've looked at this, and a risk associated with industry. We just saw this on a real commercial credit report, okay? And the employee size. We just saw this on a real commercial credit report and talked about how all of these things are directly within your control. Now, if you're getting value, do me a favor, hit the like button. Hit the love button. That's all I ask. One thing I ask is that if you're going, wow, I didn't know that, this helps me better myself to be able to get money, hit the like button, hit the love button. If you're really getting value, share this. It's how we get more entrepreneurs in here to be able to help more people. Dion, thanks for coming in and saying hello. And Derek Harper. Derek is here. Thanks, Derek, for tuning in, man. What's up, brother? I appreciate this. Derek shared it. You can always tell Derek shares it because like hundreds of more people come in here. Derek, thanks for joining me, buddy. And Will Shoes World, thanks for coming in as well. So the credit summary section, this contains several accounts for various data points. For the most part, the details are available of current days beyond terms, predicted days beyond terms for a particular date, average industry day beyond terms, and payment trend indicators. So let's look and see what this actually looks like. So here is this little summary section, okay, where we see the important stuff they want us to know. We see the days beyond terms. We see derogatory filings. We see fraud alerts and high-risk alerts here as well. And then we see an overview of those two main scores, IntelliScore, and then we also see financial stability risk score. So we see an overview of these scores, and then we also see credit limit recommendation, how much money you should be lent. Now, here's something interesting I want you to notice. Watch this. Here's somebody that has no credit. We've looked at the credit report. They're $1,000 they're being recommended for. Then we go and we see somebody being recommended for $2,500. And the only difference is this person add one account on their business credit report. The person that's getting recommended for only $1,000 has none. So what's happening is the more trade lines we're adding, Experian's bumping up the credit limit recommendation. Here, I'll show you this trend. Okay, this is what you need to know to be able to get the best scores and the most money for your business. So now if we look at this credit report, she's got what? How many we got here? One, there's three, there's 6 accounts on the business credit report here, 6. And now look at the credit limit recommendation. The credit limit recommendation is almost 16 grand. And by the way, the scores aren't even that good. And we still bumped the credit limit recommendation. So what we see here is a trend of the more accounts you add to a business credit report that are reporting, the more trade lines, payment experiences, the more they recommend to lenders and credit issuers you should be lent. So if you ever get credit cards, credit lines, and loans that aren't high enough for you, you want higher loan amounts, higher limits. Now you know why. You're not getting higher limits because Experian, D&B, and Equifax is not recommending you for high limits because you're not doing enough to add positive accounts to your business credit reports. So again, this is a summary section which summarizes a lot of that information. Days beyond terms, DBT, very popular in the commercial world where we talk, when that's what that means, is DBT is days beyond terms. So the credit summary, the lowest 6-month balance, the highest 6-month balance you've had, the current total account balance, the highest credit amount extended, the median credit amount extended. So this is basically how you're managing your credit. And let me see, if we come down here, we can see the days beyond terms in the summary section. We see the trades. We see your 6-month average of paying your bills. We see all that public information here as well. UCC filings, judgments, tax liens. UCC filings just when a lender tells the credit bureau you have a loan. That's what a UCC filing is, right? Here's the highest days beyond terms the last 6 months, the highest days beyond terms the previous 5 quarters, your monthly average days beyond terms, your predicted days beyond terms, your current days beyond terms. Okay, all your collection data is here. All of that information is in the summary section. Okay, so this is where it's like a summary for them to see basically an overview of how you're really paying your bills. Now, the section also contains number of trade lines, number of lenders, experiences, number of business filings, use filings. We just looked at that. All that stuff is in that summary section. Okay, it also contains number of banking, insurance, leasing accounts you have, a percentage of business scoring worse than company outlined in the report. Very interesting. A percentage of businesses scoring worse than the company outlined on the report. Again, another reason you need to know your NAICS code. We saw this right up here. They snuck it in on us. A percentile, okay? So what a percentile is a percentile is where you score in a percentile of other businesses. Now, this is why this is important. So let's say that where we score Credit Suite amongst all other businesses that report to Experian. That's the first percentile Experian looks at. The second percentile is called an industry percentile, and it's just like what it sounds like. How does your company score against other people in the same industry? Why you got to have your NAICS code right? If you don't know the industry code that you're in, if you don't know what your NAICS code is, if you haven't chosen the right industry code for your industry, they are literally scoring you against other people in your industry. They are knocking you down because they don't like your industry, and they could be looking at the wrong industry. So you've got to get these commercial credit reports, and you've got to look at them to know, is this really your correct industry? Is your industry in SIC 4119? Is your NAICS really 485999? If it's not, you got to dispute it with them and you got to correct it. You got to be hitting the right industry. If you're not assessed in the right industry, you got all kinds of problems because your industry percentile scores are off because you're not even in the industry they're comparing other people to. Okay, not to mention you got problems with the IRS. The reason these codes exist in the first place was for the SEC and the IRS. It's for the IRS to look at other businesses in your same industry and determine what their expenses are compared to you. That way, if you have expenses that are way out of the norm from other people in your industry, the IRS, you know what they do? They audit you. That's how they figure out how they audit. Because what they do is they look at your expenses compared to other people in your same industry. And if it's way out of whack, that's what triggers an audit. So there's so many reasons you got to have this NEICS person figured out. If you don't know your industry code, you're starting to see all these problems compound. Now you've got IRS problems. Now they want to audit you because your expenses don't make sense for the industry because they have the wrong industry. Now we can see here that your credit scores are low because they don't like the actual industry that you've actually is on your credit report. They're actually coming here and saying, hey, we don't like the actual industry, so we're going to give you a lower risk or higher risk. They don't like where you compare, so your comparison scores are off as well because you're being compared to people in an industry you're not even in. So you've got to really make sure that you've got that NEICS figured out. If you don't have that done, then the problem is that all these things get out of whack. You've got to know your industry. So when you apply for credit, for example, a loan, anything, and you go to get a bank account and they say, what industry are you in? What you really should be saying is you should be saying, well, my industry is I am in residential property manager and my industry code is 531311. They're not even going to ask you for an NEICS code. They never do. But give them that. When they say, what industry are you in? I go to my banker. I say, I'm in residential property management. My NAICS is 531311. Now they can't be confused. They have to put me in the right industry because I've told them exactly what it is. There's no guessing. They're not trying to guess one of the 32 different sub-industries of real estate. Now, if you're getting value from this, hit the like button, hit the love button, hit the share button. Make sure you like and subscribe as well so you can get our future training on exactly how to get the most money for your business. This is a key component to making that happen. Now, the credit summary also has judgments filed, amount of collections, background information. It includes information on founding date, where the company's headquarters are, and a basic background of what the business does. So all of that is in the summary section as well. If they actually have that in the summary section is where that will be. If we look at the summary section, we can also see if they have any of that information, we're going to see that down here. Let me see if Christine has on her credit report in the summary section, a lot of that. So most frequent industry purchasing terms. Okay, so again, even more of this to do with the actual industry. So it's why it becomes so important that you have that industry correct. Okay, payment trend summary. This is basically the graphs of how you pay your bills. This is basically the trends monthly and quarterly of how you're actually paying those bills. And again, we look at the quarterly trends of how you pay your bills. Okay. And then over here, we also look at the trends as well. So we see these trending data of where your scores are based on how you pay your bills. Because remember, the Intella score is primarily based on how you pay your bills. Are you paying it early, on time, days beyond terms, how far are you behind terms, etc. Now, this also shows recent payment information by month and quarter, continuous payment trends, newly reported payment trends, combined payment trends. It's all about payment trends. It's all about how you pay your bills on average. And here's why it's just so important. In the commercial world, this is the driver of your scores. How do you pay your bills? Do you pay your bills on time, early, late? Do you pay them how late? 7 days, 30 days, how early? 7 days, a week? And that determines your score. So there's a lot of emphasis put on days beyond terms and how early and late you pay. And I love that because that just means you just need to pay your bills on time or early. If you pay your bills on time or early, so much of this stuff will self-correct. The key to building good business credit really is two things. Get accounts that report to the business credit reporting agencies. Pay those things as early as you can possibly pay them. And what I mean by that is if I get something from Quill lets me pay them the minute the item ships. You never want to pay it before it ships because it won't count as credit. It'll count as a cash transaction. You always want to wait till it ships. Okay, but after it ships, I pay it instantly. But Office Depot, they won't let me pay when my item ships. They make me wait till a statement is populated to pay. But as soon as I can pay, I can pay. Get accounts that report to the business credit reporting agency. Pay them on time or early. If you do those two things, it's going to help you get good scores and good reports. Okay, then we also look at trade payment information, the trade line experiences, age trades, payment trend detail. Okay, this is all about basically how you're actually paying your bills. And when again, we've looked at this section as well. This is all down right here. This is, hey, trade payment information, lines reported, days beyond terms, recent high limit, balance, current, how many days, 0 to 30, 30 to 1 to 60, 61, 90, 91, how many accounts fall into those categories. Then we come down here, we see the trade lines, we see the reported date, the last time you used it, okay, the time, type of terms you have, credit, net 30, etc., the recent high limit you've used, your balance, and exactly the same. Now, here's what I want you to notice that's very important. Very important. You notice there's no limit information here. Neither one of these sections say anything about your credit limits. We have how the payment terms, we have recent amount of credit you've used, we have your balance, but we don't see limits here. So commercial credit reports don't show limits. They show the recent amount of credit you've used. And this is why this is so important. So many people try to build business credit to get to the next step. I want a Visa card. I want a MasterCard. I'm going to go get Uline and Quill and Granger, and then I'm going to go get Staples and Office Depot. Then I'm just going to get the number of trade lines I need to move to the next tier. But the problem is that if you want to move up in the tiers of business credit building, you have to be using this credit. If you're not using this credit and you're spending less than $100 and $100 and $300, then you're never going to get high limit accounts because they don't see that you're using the credit you're being given. So it's very important that you come in and that you use the credit you're being given, because by using the credit you're actually being given, that is the key to actually being able to come in and be able to get higher limit accounts. And then those higher limits really make a big difference into your actual score. Inquiries, collection filings, collection information. This is just all that. How many collections do you have? How many inquiries do you have in your credit report? Not the sources, but how many of them you have. What other public records do you have? So we see the inquiry section down here. Inquiries do not affect the credit score. They do not adversely affect your main credit scores. They are taken into account into some secondary scores, but not your main credit scores. And then again, we see any collections, judgments. I don't have any of that here. If there was any of that here in this, this is the section on these credit reports it would be. Here's more inquiries, but I don't see anything else here. Now, here is some additional business facts. We talked about this earlier. So this is some stuff that shows our credit reports, okay? Hey, the following information was provided by the state of Missouri, state of origin, date of incorporation, active business type, charter number, corporate linkage. This company is connected to these other companies we found. So if they found other corporate linkage, other businesses that look like you're linked, they put that here. And then we have additional business facts, as you can see oftentimes, even as they say, provided by the actual Secretary of State in the state that you're in. And a collection data is going to be on there as well. There also is a section for commercial banking, insurance, leasing. It just talks about the type of leasing accounts you have, leasing institution name, product type. But none of the credit reports I've shown you have this kind of information. But if you do leases, those kind of things will show on there as well. Okay, for leasing, it shows the scheduled amount due, the number of payments per year, the number of payments which are current, late, or overdue. So if we had credit reports that show this, it would be a section with commercial banking, insurance, and leasing. That'll be on there as well. Maria, thanks for saying hello. Sista, thanks for saying hello. Dion, what's up? Thanks for coming in. Appreciate you saying hi. Judgment filings. This shows the date and the plaintiff, the filing location, the legal type, the document number, the liability. So lawsuits will show in your credit report. So will judgments. So will bankruptcies. Any kind of public record event will show on your business credit reports as well. There's a separate section just for all of that information if you have that. And they're same as if tax filings. If you have tax filings on your commercial credit report, we will see that this information is on there as well. So we will also see, and let me see if I can pull up. I'm just going to see if I can pull up any credit reports that have that information on there. Okay, here's that payment trend. We didn't see this on another report. Remember I told you how they show you the monthly and quarterly payment trend? If they have that, here it is. This is what it looks like. The monthly payment trend, current 96% of time, 96, 97, 96, days beyond terms, 2 days beyond, 1 day beyond. So you notice that even 1 day beyond terms or 2 days beyond the payment date, you can actually will hurt you. So not the same with consumer credit, right? With consumer credit, what happens is with consumer credit, you can go 30 days late behind before you're considered late. In the commercial world, 1 day beyond terms, as you can see, will adversely affect your credit score. And then we see those quarterly trends that are right here as well. This person has a lot of corporate linkage. We have a lot more inquiries. But again, I don't see any public records on this credit report. I'm going to pull up maybe 10 of these just to see if I can see examples of what I'm telling you. Here we go. Here's something additional as well. So here's what happens if we have UCC filings. UCC filings is what tells other people that you have outstanding loans. And we can see all this information for UCC filings. that actually shows up here. Okay, the UCC was terminated on this date, filing number, original jurisdiction, secured party. Okay, all that information. The file, it was filed on this date. Here was the actual secured party. Here was the collateral undefined. Okay, so collateral undefined. So you can see all that. Anytime you get a loan, they're going to put a UCC filing in your bank report, your credit report. Now, here's why I support. We went to get an SBA loan. We had a loan that we paid off a year before, and the bank went out of business, and they never showed our UCC filing as terminated. So then part of the requirement was to prove that the UCC filing was terminated. It was tough because the bank had closed. So this delayed us for weeks in getting an SBA loan because we had to go through and verify that that was closed. So I just want to give you an example of what UCC filings are and how they can actually create an issue. Here's corporate linkage. Again, here's inquiries, but I don't see here any collections data either. So let me open up a couple more credit reports just to see if I can pull up an example of those. But I don't see any there either. And so I'll open up one more. And if I don't see that, then we'll move past it because you don't have to see that. But I thought it would be nice if you could see that. Okay, so we've seen a lot of these other sections, but this tax filing, if there are tax liens, if there are collections, all that information is in there as well. Here we go, UCC filings. We just looked at this. Date, filing number, jurisdiction, secured party, activity filed or not. And again, we just looked at several of those examples with UCC filings where you can actually see how these show up on the credit report. And again, this is what they show up with. Here's all the information. So whenever you get an outstanding loan, that shows in this UCC filing section as well. Okay, and again, all that information we just looked at for UCC. Okay, and cautionary, the accounts, account receivable, contracts, but again, we just looked at that section. So how do you improve your scores? Well, first of all, they suggest that you improve your scores by getting accounts that report to them. Okay, so even Experian says, well, you want to improve your scores? The number one thing to do to improve your Experian scores is get accounts that report to Experian. If you get accounts that report to Experian, that will give you good scores. Pay accounts on time or early. That's the number one thing I said that you need to do. And you also need to make sure that you're working with people that do report. If they don't report now, see if they will report. And also lowering credit utilization will make a difference with Experian. Equifax and D&B's main scores, it won't, but it will with Experian. Utilization is part of the score. So having a lower balance and related to what the actual limit is something that can actually help improve your scores as well. If you want to monitor your business credit reports, you can go to creditsuite.com/monitoring. If you're a client, you can go right in your back office. It's there. creditsuite.com/monitoring gets you credit reports for $24. It's the cheapest in the world. Okay. And the reason we do that is because we don't try to make a bunch of money on credit reports. We wanted clients to have a cheaper way to be able to get credit reports. It's $249 from Equifax, Experian, and DME Direct, $249 a month. Here, it's only $24. And I'm going to show you how to get your credit reports in a minute for free. But if you go to creditsuite.com/monitoring, it's $24. You get Equifax, you get Experian, you get D&B. It's the cheapest credit monitoring in the world, and you can see your main scores. You can see this information on your reports as well. So to recap, they have reports that are dramatically different than consumer reports, right? They do use the IntelliScore Plus is their newest score out that they use. Okay, remember, they do have a blended score. Remember to know how you actually look at your credit reports. Also, make sure you get credit monitoring to keep an eye on them and follow my tips for improving your scores. Now, if you want to get your credit reports for free, then give us a call, 877-600-2487, and we will get your credit reports for you at no cost. Actually, we'll do a consultation. We'll do three things. First, we get your credit reports with Dun & Bradstreet, Equifax, Experian, and we go over those with you and give you tips and tactics to improve your scores. It costs you no money to get your credit reports with us. It's 100% for free. The second thing we do is we do a fundability assessment. Most people are denied for loans or credit lines because they jacked up their fundability. They didn't set up their entity type right. They didn't set up their industry right. They didn't do a lot of the things that I showed you from Experian reports today cause the scores to go down. Let us look at that for you. We'll give you advice, tips, and tactics to improve your fundability to help you qualify for loans and financing. And speaking of loans and financing, we'll qualify you right there too. We worked over 1,000 funding sources. We'll tell you, hey, here's the loans you can get now. Here's the credit lines you can now. Here's the sources you can get them from. And we'll help guide you of where you can go to get money as well. All that happens on a free consultation. All you have to do is give us a call, 877-600-2487, 877-600-2487. Email us info@creditsuite.com or go to creditsuite.com/consult to be able to get scheduled. And if you'd like to learn more, Tuesday and Thursday at 11 o'clock on Wednesday, we go live on Facebook, on YouTube, and also on LinkedIn. If you follow Credit Suite at Credit Suite's Facebook page, facebook.com/Credit Suite, youtube.com/Credit Suite, or my LinkedIn profile, which is like just find Ty Crandall on LinkedIn, you will actually be able to access our lives. We also have a ton of information on our social links at the top right of our page, creditsuite.com. Daily tips on Instagram, daily tips on Twitter and on Facebook, hundreds of videos on YouTube that teach you how to read, how to control your commercial credit reports, how to get your commercial credit reports, how to build business credit, how to get financing. Everything you need to know to get money for your business is on our YouTube channel as well. And then we have 2 podcasts, the Business Credit Financing Show, over 500,000 downloads. We have all kinds of experts that come on and teach you everything you need to know about running, starting, and growing a business. And then we also have a podcast that's dedicated to influencers, how they became influencers and how you can too. You can access our podcast at the top right of our page, creditsuite.com as well. And don't forget, if you got value, hit the like button, hit the love button, hit the subscribe. It's all I ask. Okay, if you got value from this, then that shows the social channels that you got value, and then that helps me help more people. In my life is dedicated to helping entrepreneurs like you get money. So if you do that one thing, I appreciate that. And by sharing it, then you bring your network in and help them get money as well. So I look forward to seeing you on our next training where we talk about more cool ways to grow your business. Don't forget to give us a call for your free consultation, 877-600-2487. Get your business credit reports for free, tips and tactics to improve them. Get a fundability assessment for free, tips and tactics to fix that. And we'll do a free funding qualification, tell you all the money you can get now by giving us a call at 877-600-2487. That's 877-600-2487. Thanks for tuning in. Have a great day.